Welcome back to Investing Talk Podcast.
Today we're looking at Boeing.
As usual, before we start, subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. What's so fascinating here is that we're really analyzing a high-stakes, multi-year recovery story. I mean, Boeing is still firmly in that turnaround phase.
Still navigating all those manufacturing ramp-ups and, the quality challenges.
Exactly. But the investment argument is really starting to crystallize now. The market sees this structural financial inflection point approaching.
Which management has pegged for 2026, right?
That's the year. And this isn't just about, gradual improvement. It's about a fundamental shift in their cash profile.
Okay, so let's unpack that with the recent data, because you can see some of the early signs showing up in the top line.
You really can.
We're seeing some real, meaningful revenue acceleration. If you look at Q2 2025, revenue surged, 35% year over year?
Yep, to nearly $22.8 billion. Comfortably beat expectations.
And that momentum just kept going into Q3, another 30% growth year over year to $23.3 billion.
That kind of high-velocity growth is just so difficult to achieve in manufacturing. It really speaks to a significant production ramp finally getting underway.
And that momentum is, it's almost entirely tethered to the commercial airplanes segment, right? That's the core growth driver.
Absolutely. They managed to deliver 160 aircraft in Q3.
160. And that's the highest delivery number they've achieved since 2018.
Right. And that metric 160 planes, that is the physical proof that the supply chain and the internal processes are finally starting to normalize after years of just disruption and oversight.
Okay, that's a crucial point for volume. But here's where we shift from volume to value, because despite that huge increase in deliveries, the commercial segment is still very much in the red. The operating margin was still, negative 5.1% in Q2. So they're solving the volume problem, but not the profitability problem. Is that just a cost of scaling up?
It is, in part. It's an execution story where they're front-loading all these costs.
For training, supply chain.
All of it. Workforce training, supply chain premiums, catching up on delayed work, what they call deferred production costs. The market gets that this segment won't turn solidly profitable until the delivery rate stabilizes at a much higher level.
Something like 60 or 70 737s a month.
Exactly. The whole challenge now is converting that massive backlog into actual margin.
But there is a cushion, right? The defense, space, and security segment is providing some stability.
It is. Q2 defense revenue was up a solid 10% to $6.6 billion.
Which is a nice lift. But more importantly, they actually returned to an operating profit.
A small one, but yes.
Yeah.
About $110 million or a 1.7% margin.
That positive swing is vital. I mean, that division has been a consistent headache and a cash drain for years.
Precisely. Defense provides the floor for the entire operation. It offers predictable, contractual revenue and now margin that helps insulate the business from those commercial shocks.
So defense is the floor, but the real upside, the ceiling, that depends entirely on the financial future that management is selling for 2026.
Right. And this is where the story shifts from, operational recovery to pure financial engineering.
And that's where it gets really complex. I mean, management's roadmap to 2026, it isn't just incremental.
No, not at all. They are guiding toward a completely transformative financial profile. The whole investment thesis really hinges on believing those targets.
And they're being pretty direct that this year, 2025, is still going to be a loss-making year, right, as they burn through those costs.
Yes, exactly. But the 2026 guidance is a leap, a huge leap. They're aiming for a full return to profitability.
So break it down. What are the actual targets?
They're targeting greater than 700 aircraft deliveries across all programs.
Okay, 700 planes.
Roughly $80 billion in revenue.
Net earnings.
Earnings per share of about $3.50. But the big one, the one everyone is laser focused on, is free cash flow, the FCF.
And they're guiding for roughly $5.6 billion.
$5.6 billion.
That FCF figure, it's the linchpin, like you said. But I have to ask, given the legacy of execution failures, the missed deadlines over the last few years, how much of that is realistic and how much is just aspirational signaling?
That is the core question for the stock right now. And it explains why the market applies this execution discount.
Right.
That $5.6 billion FCF is definitely the aspirational top-end target. It assumes a near-perfect operational ramp-up.
And no major external shocks.
Right. If you look at independent analyst forecasts, they're much more conservative. They're projecting 2026 FCF closer to, say, $2.5 billion.
Okay, so that's a $3.1 billion gap between their guidance and the consensus. That's the risk-reward right there.
It is.
So the bet is really on the direction more than the specific number. Even $2.5 billion in FCF, when you compare it to this year's expected $2 billion cash outflow.
It still represents a massive structural cash inflection.
And that's what the sophisticated money is positioning for.
Precisely. The bottom in cash burn is near. And to prepare the financial decks for that, they've been heavily focused on balance sheet repair in 2025. One of the biggest de-risking moves was selling the Jeppesen division
To Thoma Bravo for about $10.5 billion. I think some people might miss how significant that sale was. What does selling a digital navigation arm really tell us?
It tells us they're laser-focused on their core competency, building and servicing airplanes.
Right.
Jeppesen was a specialized non-core service.
Yeah.
Selling it gave them that $10.5 billion in immediate liquidity.
Which they can use to strengthen the balance sheet, reduce debt,
and free up capital to reinvest in their struggling manufacturing lines. It signals a complete focus shift back to the factory floor.
Okay, let's shift to the long-term competitive landscape. Because when you invest here, you're not just buying a turnaround, you're buying into a deeply entrenched structural advantage.
You are. We are talking about the ultimate duopoly with Airbus.
And that duopoly is the moat. It's almost impenetrable.
It is. I mean, it's not just about scale. You have to consider the colossal barriers to entry.
The regulatory hurdles alone.
Exactly. Certifying a new large commercial jet takes decades and tens of billions of dollars. The FAA and other regulators, it's functionally impossible for a new entrant to clear those hurdles quickly. That ensures they keep their pricing power for the long haul.
And the beauty of that duopoly is how it feeds the services unit.
That's the profit anchor for the company.
It consistently maintains stable, high margins, usually around, what, 18%?
Yep, around 18%. And that provides recurring, high-margin cash flow that smooths out all the volatility from the other segments. It's built on that massive installed base of planes already flying.
Leveraging that for maintenance, parts, analytics.
And that market is huge. The global services market is estimated to be $4.7 trillion from 2025 through 2044.
Wow.
Boeing's proprietary knowledge of their own planes gives them an incredibly strong moat in capturing that revenue stream.
And speaking of leveraging an installed base, the defense unit is also strengthening its backlog. We saw that recent contract.
One for Poland.
Right. The $4.7 billion U.S. Army contract for 96 Apache helicopters.
That deal reinforces their critical role in allied government programs. It shows that global defense spending is a strong, persistent tailwind they can rely on.
So this clarity on the future cash profile, it's clearly shifted market sentiment.
It has. After the CFO gave that upbeat 2026 outlook at that UBS conference, the stock staged what some analysts called a bullish breakout.
It jumped more than 8% in one day.
It did.
And technically, the price action is confirming the story. The stock reclaimed and held above its 50-day moving average, and it's starting to challenge that longer-term 200-day average.
That's a classic sign of accumulation. It suggests investors are finally starting to discount that 2026 inflection point. You're moving from wait and see to actually positioning.
And we can see tangible evidence of that. There was a recent disclosure from 1832 Asset Management.
Right? They initiated or increased a position with a $2 million investment. It's a concrete signal that institutional investors are making these multi-year bets on the turnaround.
Okay, so what are the key catalysts we should be watching for in the near term?
The first critical validation point will be the next earnings release, Q4, and the full year 2025 results.
They have to show that free cash flow is turning sustainably positive by Q4.
Absolutely critical for validating the entire roadmap. If they miss that target, that execution discount will widen immediately.
The other big catalyst is progress on the Spirit AeroSystems acquisition. Deeper integration there could unlock huge efficiencies.
It could. Spirit is crucial. They handle the fuselages, which have been a major source of quality control headaches.
So bringing them in-house is essentially vertical integration aimed at solving those core quality problems.
Exactly. It gives them control over the entire system, from the fuselage to final assembly. It could accelerate margin recovery and reduce the risk of those supplier issues.
Now, we've covered the bull case pretty extensively, but we can't ignore the massive risk here. They operate under that execution discount for a reason.
That execution risk is the primary concern. Any new quality control problem, production delay, or, God forbid, a new safety event.
Especially with the 737 or 787.
It could instantly erode confidence and just completely derail the recovery timeline. One major incident could cost them years of gains.
And then there's the internal financial drag, the 777X program.
A huge one. Q3 results included a non-recurring $4.9 billion charge on that program.
And that wasn't a fine, right? That was to cover deferred production costs and expected losses from all the delays.
It's a massive financial black hole right now. And what's more worrying is that management expects the 777X to keep consuming cash through at least 2027, maybe even 2028.
So that puts a hard ceiling on how high free cash flow can really go in the medium term.
For sure. And legal and governance scrutiny also persists. There's still ongoing shareholder rights investigations.
Which adds overhead and distracts management.
True. But there is a silver lining there. Many analysts believe the largest legal settlements related to the biggest past issues have already been recognized. And front-loading at $4.9 billion charge on the 777XO. It clears some pain now.
Setting the stage for cleaner earnings reports in 2026 and beyond?
Potentially, yes.
So the ultimate optionality, the big upside for shareholders, is the potential restart of dividends and share buybacks.
Which were historically a material part of the total return, absolutely.
Yeah.
But that is entirely contingent on them executing that 2026 FCF plan.
Whether it's the $5.6 billion or even just the $2.5 billion.
Right. Until that structural cash flow inflection is proven, the focus has to remain on deleveraging and reinvesting. The market won't tolerate buybacks while the balance sheet is still under repair. So I guess the concluding thought is this. Boeing represents a high-conviction, multi-year recovery opportunity. Investors who can tolerate the known execution risks, like that 777X drag, are essentially betting on a massive backlog, the safety of the duopoly mode, and these powerful macro tailwinds from air travel and defense spending.
All positioning the company for substantial free cash flow compounding starting post-2026.
The key is just monitoring that FCF confirmation in the next few quarters. That's the signal.
If you want more in-depth analysis on cyclical turnarounds or defense industrials, let us know in the comments. Thanks for tuning in to the Investing Talk podcast, and be sure to subscribe for our next analysis.